Good morning, everyone, and welcome to the UPGS interim results presentation. Numbers were out on Friday. I hope you saw them then, but now we shall hand over to the team. Over to you, Simon.
Thank you. Good morning, everybody. Hope you all had a nice long weekend with the rain. So we did do the Capital Markets Day a few months ago. And Andy obviously presents a lot to this forum. So we will recirculate, as Anna's just said, the video again. But just to go over some of the main points of the business, our mission as a business is to put beautiful, affordable products in everybody's home. We sell just above own label pricing in the retailers with a brand and with the quality. And that's what creates the volume for us. So just some of the highlights. The Beldray brand, which we own, is our biggest brand by far. It's resonated very well in the supermarkets and online with Amazon and other online retailers, Shop Direct, Very, Freeman's. It's also doing very well now in Europe. So it took us a good year to penetrate, but we've now got it in supermarkets and some discount stores in Europe. And we are getting very strong repeats. So it is being seen now as a brand in the European market, which we're very, very pleased about. As you're aware, we bought the Petra brand a few months ago, which was a small domestic appliance brand in Germany. We will be relaunching this probably the beginning of next year, January, February, and we're going to focus very heavily on the small domestic appliance market. We're bringing a big coffee range out, coffee making machines. Coffee making machines are very on trend now because of the pods. People are using less pods, and bean to cup is the new coffee machines, and we're seeing great sales in the UK. And this is how we're going to launch Petra in Germany. We're also going to launch and spend a lot of time on the environmental side of Petra. So our packaging will be FSC, there'll be no plastics in it. And also, if you buy a Petra product, we will be planting a tree. So environmentally wise, it's going to go into the market as a strong brand. So we're very excited about that going forward. On the next page, you're going to see the results. I'm going to let Graham go through a lot of these results in detail. But as the founder of the company, I'm overwhelmed and proud what the team has delivered. It's just remarkable, the figures that we've done, because it's been a very, very tough year. We've not just had COVID. You know, Brexit has been very, very difficult for what we do, sending out as well into Europe. But shipping as well, we've had a big headwind with the shipping and cost prices. But the talent that we've got in our business is just improving all the time. We've still taken on over 30 graduates this year, and we're training them, and it's just going from strength to strength. It's very impressive how they've been able to adapt in such difficult times and overcome a lot of issues. So it gives, again, it's a great future for Ultimate Products with its people. I would say one of the most exciting things throughout the last 12 months, because there's been a lot of hard things, but there's been some great exciting things, but the most exciting for me is the way the business has adapted on the environmental side and the community side, which again, Andy's going to go into. We started our environmental committee just before COVID, and it was the most people wanted to join the committee than ever before. There was over 20 people in there now, and it is making big changes in the business. We've been taking plastics out of our products, polystyrene out of our product, turning our packaging into FSC, and there's so much more exciting things. Our new office that we're moving into, no plastics, paperless, energy-wise, and it's just growing and growing. And just watch this space with Ultimate Products, because we want to be industry leaders in environmental and community, and we're very, very passionate about doing this. One of the highlights on this page I will bring to you is, as you can see, our banking facilities. I think this month we're actually cash positive. So extremely strong banking facilities, gives us firepower if there is any more acquisitions. But it also means after this really tough year, we're coming out of it really strong. So feeling confident, even though we've got these lovely headwinds. So next page. I'll hand over to you, Graham.
Okay, so the results for the half year. The headline is that you can see revenue growth of 11.4%, strongly driven by particularly strong contributions from the supermarkets and online. You will note down just a gross profit margin, a reduction there from 23.6 to 22.8, largely due to a reclassification and an investment into online marketing spend, which is helping drive our online growth over the period. Other than that, there's a small improvement in margin. If we move down to underlying Ebitda, almost 21% up from the 11% on sales, 8.8 million in this half year. But I think more importantly, the 0.9% improvement in the underlying Ebitda margin. We spoke before about improving our operating margin with a midterm target of 10%. We're continuing to progress on that path with the strong product development, and that's then coupled with the ability to leverage a longer product life cycle through the online and international channels, allowing us to recycle products for a longer time on, or to list products for a longer period online, and to recycle that development as we've already done in the UK across our international geographies. So improvement in the underlying Ebitda margin, like I said, 10% is our medium-term target, and the extra development research note issued on Friday for FY21 is forecasting 9.5%. Just very briefly, exceptionals, just to remind you, ordinarily this is just share-based payment charges, but in this half year we repaid the furlough monies that were accredited last year, so that's the increase there. And if we can then move on onto the bridge chart. I think the key point here is I talked about improving the underlying Ebitda margin there, and one of the key areas of that is our relentless focus on delivering productivity improvements, just small improvements and lots of them day in, day out. So here you can see that we've got a strong revenue growth, as I mentioned, 11%, but the key visual is that overheads chart bar broadly flat with the prior year, in spite of that 11.4% increase in revenue. So with the same level of resources, we've delivered that increase in revenue, the increased volume through the order book, and that's helped drive the operating margin to the improvement we saw over this half. Moving on to the next slides, we've got the segmental analyses. Firstly, geographically, you can see the strongest growth was in Germany, where the team there are doing a fantastic job. Particularly, growth was coming from supermarkets in Germany, and the UK also very strong with a combination of supermarkets and online. The rest of Europe was impacted quite heavily by the store closures, so we did see a decline there, although we kept very close to those customers, supporting them, so we're there ready for them as they reopen. On the pillars, broadly reflects the geographical comments, the strong developments from the supermarkets and online. And for H121, the share of supermarkets and online was almost 43%, which is up from 35% in the same period last year. So continued development and growth in those two sectors to give us a nicer, broader breadth of customer base. And then if we move across onto the brand schedule, you can see that Belgrade continues to be our #1 brand, 21.5 million in this half year with almost 16% growth. But overall, the Premier brands showed strong growth as well, 20% growth. And included within that is the two new boys. We've got Progress and Clean Easy, both delivering very pleasing results in that in the half-year period. And then finally, from the segments, we've got the product groups. And what you see here is we believe that there has been a shift now from the consumers, and they will be spending more time at home. There'll be an increase we'll continue the increase in home cooking and home cleaning. And that's playing into the hands of our three top areas there, SDA, housewares and laundry, all showing strong growth in H1 21. Okay, and from the balance sheet, still remains simple. We are capital light in spite of IFRS 16, which IFRS 16 accounts for almost 3 million of the tangible fixed assets. So without that, a relatively modest level there. In terms of working capital, stock remains flat, seeing growth in debtors coming from the increase in volume. Debtor days at the end of the year, half year were 52, which is within our normal range. And we're seeing an increase in creditors, which compensated for the debtors increase, as the supplier terms we have from most of our Far East partners have continued to increase. And from a debt perspective, very pleased, continuing to deleverage with debt at the end of the half year of 1.5 million, net bank debt of 1.5, leverage at 0.1 times, and continuing with very strong levels of headroom, as Simon said, leaves us in a very strong position as we come out of the pandemic. Headroom of over 25 million and very comfortably within the banking covenants. Then move over onto the cash flow statement. We saw a very strong conversion of Ebitda into cash in FY20. That's continued with, as I saw on the balance sheet, broadly flat levels of working capital. So strong conversion continuing down. The increase in fixed assets expenditure relates to the investment in the head office. So, and that's 500,000 in the first half year, expecting around about 2 million in total to be complete largely by the end of the year. And the other point to note really is our dividend policy remains as 50% of underlying profits after tax. So that allows 50% to be retained, and that's what's contributed to the deleveraging of the business over the last few years, and particularly in recent periods. On the dividends note, just to point out that the dividends paid in H1 21 includes the interim dividend from FY20, which was deferred at the time and would have ordinarily been paid at the end of July. So that's sort of a one-time impact just on the cash within this period. And if I can hand back now to Andy.
Just remember to unmute just in time. Hi, morning everybody. Many of you be familiar with these kind of 4 pillars of our strategy, because we've kind of gone on about them for quite a few years now, but they remain as relevant as ever. First of all, international. We have with a particular focus on Europe and within that Germany, where our Cologne office is. And really this is all about leveraging product developments that we brought to market for the UK into those other territories, and getting the increased revenue, but also the increased operating leverage and ultimately EBITDA margin that comes with that, because our greatest investment is always in our upfront product development. And secondly, supermarkets. In historically we were underweight with supermarkets, and these are the mass market retailers that most people go to every week to shop. We always felt that our branded offer at a price point just above own label would resonate with the supermarket consumer, and that's very much proved to be the case. And we've seen a few years now of rapid growth here, and and a significant increase in our share coming from supermarkets, both in the UK and increasingly in Europe. And what we're finding is that as we go into Europe, we're quite often going straight in at supermarket level, rather than as was the case with the UK, where we kind of started with discounts and graduated into that supermarket category. Number 3, online. I think when we IPO'd in 2017, online was sort of low single-digit share of revenue. It's now approaching that 20% target that we set ourselves at that time, and we've set ourselves a new target that we want to see 30% of revenue coming from online channels, both in the UK, where there's still substantial room for growth, and as we reach out into other territories, particularly via the Amazon platform and via other platforms such as eBay and retailer dropship options. And then last but certainly not least, discounts. It's continues to be a rapidly growing segment, both here and internationally. It's really where our heritage is. You know, discounters really latched onto our strategy of brands at own label prices, because they often don't have an own label option. So you know, we do continue to see we expect to continue to see growth through that segment, and these 4 pillars are very much where our strategic focus is in terms of revenue. Okay, we go on to the next page. We gave some guidance in our interim statements. We expect revenue to be in excess of 135 million, up significantly on FY20. You know, despite some, you know, still, you know, pretty significant headwinds. You know, a lot of our retailers were closed, still, or were open and closed at various points. You know, it was a challenge in terms of availability, given the sort of spikiness of demand, and also issues around and challenges around freight. So you know, we're very pleased. We will be very pleased to deliver that. Underlying Ebitda, we're expecting for FY21 to be in excess of 13 million versus 10.4 million for last year. So a high conversion of revenue growth into Ebitda because of that improved Ebitda margin, with a PBT expected to be in excess of 10.8 versus 8.2 last year. And I said before, that growth in revenue profitability has been achieved despite the commercial and operational challenges of COVID-19, plus of course Brexit, and related to the pandemic, the current challenges around freight and shipping. So I think, you know, there's no doubt that without some of those headwinds, we'd have done better again. But as Sam said earlier on, I think we're delighted, really, given the you know, given how difficult it's been over the last 12 months. We're delighted with the numbers that we are achieving. Okay, we go on to the next slide. So this was a slide from the Capital Markets Day, and I did think it was worth recycling this here. This is our look into the future and how we might fit, looking at a sort of post-COVID world. We do believe that the post-COVID versus pre-COVID, people will be spending more time at home. They may not be working from home 5 days a week, but they may be working from home 1 or 2 days a week. And if you think about even 1 day a week, it's almost a 50% increase in time that people spend at home. And we believe that's a significant opportunity for homeware brands such as ours. We do believe home cooking is here to stay. People have got used to it. Some even quite like it. And home entertaining, great value for money, and you know, without any play off on quality, I feel. And we believe this is an opportunity for Salter Russell Hobbs, Progress, and our Petra brands in time. You know, our cookware and kitchen electrical segments. We believe cleaning and hygiene will remain a high priority. We've all had it drummed into us every term, and that's an opportunity we feel for Beldrain Clean Easy. Online, obviously there's been quite a lot of spikiness around online demand, depending on whether stores are open or closed. But what it certainly has done is accelerated behaviour. We believe it will have accelerated the what was happening with the switch to online anyway by maybe 3, 4, or possibly 5 years, and that's why we've set ourselves a target to grow our share of revenue arising from online to 30% from the 20% that we set on the IPO. The next one, this is potentially more contentious and slightly more speculative, but we just think expenditure post-COVID will be more considered. We believe that people have been surprised at how they've been able to save, and they are now going to be more considered in their expenditure, because I think some of that habit will stick, and we think that's good for brands that deliver value, and our brands certainly do deliver that. We've all seen the retail insolvencies that COVID has triggered. Some of those probably an acceleration of what would have happened anyway in time, but many retailers have performed well, and they are our customers. We've not lost many customers through this pandemic. Our focus on those 4 pillars has meant, you know, and our focus on the retail winners has meant that, you know, our customers are the ones typically still left standing. So it in turn leaves us well positioned. We do think reliability for retailers will become more important. Price is always the most important, but reliability post-COVID will be more important than it was before. I think we've learned a lot about the reliability of supply chains. You know, we are a top-class supplier with fantastic supply chains and an unparalleled track record in terms of on-time delivery, for example. So this increase in reliability as a factor very much plays to our strengths. And finally, Brexit. I won't want to overplay this point, but there's certainly, in terms of the 10% of our business that goes from the UK into Europe, it's become more complex. Brexit has introduced more complexity, but complexity is what we do. You know, we supply 300 retailers every year, all with their own way of doing things, and that makes what is already a relatively complex business. And our investments in systems and processes and automation allows us to manage that effectively. So we are well placed to manage the complexity that Brexit has brought with regards to that cross-channel and business that goes across the Irish Sea. Okay, move on to the next slide. So when I'm asked, and you know, I've got 10% of the shares in UP. What is the investment proposition? These are the points that I think about, with a fourth point that we'll come to on the following slides. First of all, growth. We've got 500 million consumers across the UK and Europe to go after them, and we have barely started that journey. So huge upside for growth, huge potential for growth. But along the way, we are able to pay a dividend. We're a capital-light business model, as Graham has highlighted. We distribute half of our profits as profit after tax, and so we have that kind of, you know, slightly unusual blend of growth and income as an investment. But then really, I think just as importantly is resilience. You know, we are all businesses from time to time become challenged. No doubt we'll have challenges in the future, hopefully not another pandemic, but and having resilience, we've certainly proved this, I feel, not just because we're financially strong, as evidenced by that low level of debt, but also we have an agile commercial model that when challenges come along, we can adapt very quickly. We have a talented team of people who can improvise and overcome and almost anything that comes our way. So significant downside protection from an investor point of view. If you go on to the next slide, but I think increasingly, and we've really learned from the response of investors like yourselves, both retail and institutional, that ESG is becoming more and more important in people's considerations. I feel like we've always been great at the G. I think for a small cap, we have very, very strong governance, as evidenced by our two recent appointments of non-execs, Jill Easterbrook, former Group Strategy Director for Tesco, and Christine Adshead, former Head of Transaction Support for PwC. Two fantastic appointments to the board who have very much already shown their worth to this point. So I think with us, for a small cap, you get kind of very much a large cap quality and level of corporate governance. During COVID, we really focused on the S, and again, I won't go through the detail because a lot of you will have heard it before. But we rolled up our sleeves. We helped support hospitals, food banks, domestic abuse survivors, young carers, and young people transitioning into further education. We do visit our LinkedIn page. Do go to our Twitter. You'll see lots of examples of the things that we do in the community, and it's very much a two-way street. We're well embedded in the community of Oldham, which is one of the most deprived towns in England. But it's a great place to do business, great people, and it also has fantastic schools, so a great source of talent for us. So we do these things, but it's very much a two-way street. We get as many benefits as a business from those things. And then finally the E, where I just say watch this space. We have a very active environmental committee, very much staff led, and we're happy to be led on this. But we also see these things as very much a commercial opportunity. So some of the initiatives that we're trialing around Plant a Tree, which we expect to roll out across our entire product range in due course, have really resonated both with our consumers and with our retailers, and have actually led to, I feel, commercial opportunities that we wouldn't have otherwise have had. So I feel particularly for small cap, we're very strong on this. And with plenty to come on the environmental side, so do watch out for that. And let's move on to the next slide. So that's it for the presentation at the moment. So we'll turn it over to questions.
Thank you very much for the presentation, gentlemen. Then, right, we've got 15 questions to be making a start with. So let's start at the top. How much more could sales grow with current overhead costs?
So shall I pick that up? I think as our revenue grows, at some point, OPEX inevitably has to grow, but we believe that we can grow our revenue line at a significantly faster rate than our OPEX. And the key metric there, I guess, is that Ebitda margin. Can we keep moving? We moved it from 9 equity last year. Equity development to forecast 9.5. We've set ourselves a target of 10. We're very confident we're going to get there. It's a question of when, we feel, not if. I think beyond that, Hannah, I think it poses certain questions about what would we do if we were heading towards 11 or 12? What would we recycle that into investments in price? or areas such as marketing. And certainly what we don't want to be is, we don't want to make the same mistakes that, say, Tesco made, for example, where in the early 2010s, where they allow competitors to come in underneath them. So at the moment, we just set ourselves 10%. Once we get there, we'll have some interesting questions to ask ourselves about progress from there. We are at heart lovers of volume, I suppose. We like to drive volume. So if we can reinvest some of that additional profitability into, say, marketing or price as to drive the revenue line, then we will probably prioritise that. But we'll answer that question once we're nearer to that point.
Like you say, 10% would be a good problem to have.
Lovely.
Next up, the 30% online target that you've moved to recently, is that an implicit admission of expected slowdown in another channel, perhaps discounters?
I don't think so. I think our channels will grow I think all of our channels will grow, but inevitably they'll grow at different rates. I think in a way the 30% is a particular challenge, not because we won't grow the revenue online. It's because we will also grow those other channels. So online will really have to grow quite rapidly to not to keep up and to increase the share of overall turnover.
Okay, thank you. None of us have been anywhere for a very long time, so luggage has probably, as a sector, hasn't done that well for you. Is it currently loss-making?
It's not loss-making, because what we've done is we've redeployed resource from the luggage department into other areas. Certainly, and Simon started off this call by saying it's been a challenging year, and luggage is one of many examples, of things we've had to deal with. Luggage will come back eventually as travel returns, but we do see in the long run that the growth will come from, cookware, small domestic appliances, and laundry. But the luggage business will come back once travel returns.
Okay, thanks. What is the most surprising, not targeted commercial development in the last year? And what is the most surprising prospective opportunity? Dig deep here, Andy.
It's one for Simon, I think, but that's a bit of a hospital pass, isn't it?
I think the most commercial best thing that's happened is the team. The way they've been able to work together in such difficult circumstances, not even seeing each other, but able to bring 1,000 new products to market over the last 12 months, able to really up our game on teaching the graduates, up our game in our China office, because the China office has made a major part helping us succeed, getting on to production, bringing newness to market. The team is even stronger than it's ever been. The management team and the teams below. We've got this commercial operation that is, I feel, has always been better than most, but is now on a completely different level. And I'm looking forward to coming back to the office, bringing it all back together and watching it grow in our new office complex, which is going to be very, very interesting.
Anything to add to that, gentlemen? No?
No.
Good. Do you see any material changes to the supply chain in response to the political or economic changes around us?
Yeah, that's another good question, because the last 12 months we've been focusing a lot on the sourcing outside of China. There is certain categories where we're focusing on now. Prices are getting closer. They're not as cheap as China, but they are getting closer, and we are working on it.
Okay.
I think what we can do in the meantime, Hannah, is mitigate some of those risks. Mm-hmm. Obviously people are concerned about, some of the sort of human rights issues in China. We We've always invested in ethically auditing all of our factories, so we do a lot of work there. China is quite a difficult, its capability means it's quite difficult to move away from in the short term. But we do, you know, the commercial teams are aware of this as a priority and are looking at, you know, territories, other territories that we can source from.
Okay. Well, perhaps leading on from that, there is a question here around the widely reported logistical challenges. Obviously, Ever Given's been moved now, but with increased delivery times and freight costs, what impact is this having on your working capital and profitability?
Well, it's been a huge challenge over the last few months, both in terms of availability, so getting onto ships, and of course in terms of cost. And that's why we've guided that we do expect the second half gross margin to be 1 to 1.5 points lower than the first half. The increased costs are far greater than that, but we have managed to offset those with commercial steps that we've taken. There's no question, both in terms of revenue and in terms of margin, we'd have had a much, you know, a better outcome in FY20 than one we're guiding on. We're delighted with what we've done in the circumstances, but it's certainly we could have done better again. But you know, that is encouraging for FY22. Although after the Ever Given was stopped, I did wonder what was next, and I'm sure FY22 will bring its own challenges. And by the way, the Ever Given is still stuck in Suez, and it does have 6 containers of our luggage on it. So so we've had to manage. I mean, I think with all these situations, everyone's in the same, I was going to say boat. Everyone's in the same situation, and it's all about getting the best outcome. You know, you can't wish the problem away. All we can do as a business is do better than everyone else, and I feel that we've achieved that because of the quality of our supply chain, which is not often visible on. You know, we don't often talk about supply chain on these calls. We normally talk about the commercials. We're actually behind, you know, under the bonnet of the business. What you have is a well-developed and very effective supply chain, reaching all the way into China with our Guangzhou office, which I have no doubt we've achieved so far the best outcome from the difficult situation of shipping relative to our competitors and indeed relative to our customers.
Thank you for that, Andy. Right, a couple more here on online. Try and wrap that off. 2 things: the increase in online sales, have they had a positive impact on your working capital or your credit debtor days? And the second one, I mean, you just said then, you know, it's going to be a challenge to get to 30% because the other sectors are growing successfully as well. So what are you doing to develop the online channel further?
So, well, the working capital points, I'm conscious that in the last question it didn't fully answer that. In the very short term, we've seen our working capital drop as a result of both the increased demands for stock, including from online, and of course the difficulties in getting that stock into the market. So we do expect to see our stock levels increase by about £2 million between now and the end of July. In terms of the ongoing impact on working capital, we're finding that online is helping to accelerate our stock turn. So far, it's not really been a big driver of overall stock levels because it's the same pool of stock that we sell into our wholesale customers. So what was the last? How are we going to drive online? So just to be clear, we predominantly sell via platforms rather than through, you know, our own proprietary websites. And what we have, and Amazon is the largest one. And really, what we can do is take what we do in the UK and just replicate it across those other Amazon territories, including particularly the use of Amazon's marketing services, or AMS as it's better known. So we have a particular expertise when it comes to AMS, that we've developed over the last couple of years, including the use of software that is capable of machine learning. And that's going to be really important in driving growth into Europe, because not least we don't have the language skills to the same extent. So, you know, being able to use this technology and its expertise is going to be a key part of that. So, so yeah, the encouraging thing is it's about really replicating what we've already developed in the UK across other territories, using platforms that we're already, you know, very experienced in using.
Okay, and perhaps the last one then on working capital. Can you shed some light on the adjustments for full year 2021, and do you agree with our equity development's assessment of -6 million?
Just on that, I think the -6 million for cash flow working capital movement in FY21, so it needs to be borne in mind in relation to FY20, where we saw a significant reduction in working capital. So it's largely sort of rebalancing the position that we benefited from on cash in FY20. As Andy mentioned, we are low on stock our stock levels are lower than we would ordinarily have at the moment by around about sort of 2 million or so. Debtors and creditors tend to otherwise all of the working capital tends to fluctuate with volume. So the second half of last year was impacted by the pandemic, reducing both volumes and working capital levels. So as we sort of revert to normality this year, I think we're broadly in line with your view. We'd like to. I mean, I think Chris is showing sort of around about 8.1 million net debt. I think we'd like to sort of outperform that, as we always do. Always like to, sorry. So I think it's comfortable. We're comfortable with what you've got in your forecast there.
Well, I think we all know you're not short on ambition. So since we're just commenting on our forecasts, somebody else has asked the 6% revenue growth for 22, which is obviously in line with the wider market spending growth estimates. They question, it seems unlikely we will grow exactly in line with the market trends. So what are the factors that are going to lead to you beating it, or conversely missing it?
Well, I think as we move towards the end of this financial year, we'll have better visibility of our order book for FY22. So I think, and we're going to look to do our pre-close earlier. So we'll look to give a heads up on those numbers in August, and at that point we'll give some guide on the development of our FY22 order book at that point. But I think the question, that question is correct. We would always want to outperform the market given the channels that we focus on. That sort of international supermarkets, online and discounts.
Okay. Customer concentration, obviously it's improved and become more diversified after the very high levels at the IPO. Are your two largest customers the same as at the full year? And what percentage is your third largest? And can you comment further on this?
Well, we haven't given that information, not in the public domain at the moment. So as you know, a year end we'll disclose our two largest customers. Whether or not they're the same, unlikely to be the same, I would say. We have seen other customers sort of challenging those top two or beginning to challenge over the last couple of years. I mean, again, on the Capital Markets Day, there is, I can find, yeah, here it is. So there's some interesting graphs on there on concentration and how that's developed since we IPO'd. And we IPO'd, top two customers were 47.1% in FY17 and down to 26.1% in FY20. and certainly we KPI internally on this point. So we, you know, having worked hard to reduce that concentration, we're determined to sort of keep well diversified as a business in terms of our product base, and you know, the growth of, say, key online accounts, the growth of some of our larger sort of continental accounts have really helped with that. But we're always very careful, Hannah, about commenting on customers in you know, for commercial reasons, commenting on individual customers, because you know, our customers don't like it, and our competitors are watching. So so in terms of that, we'll say more obviously when the annual report is issued, but the diversification that we saw from 17 to 20 has certainly not gone backwards during this last 12 months.
Okay, thank you. Perhaps then a little bit now on specific brands. There's a question here on Cleanies. And I had a question, are you finding that it is accelerating, or is it still finding its niche? And perhaps does it need a sponsor outlet to help it flourish?
No, it's starting to flourish. It's going into certain retailers now, and they're expanding the ranges in a big way. I think we've found its niche, and now it's about just getting it out into the wider breadth. We have another brand, Progress, which again you can see is doing very well, and we are doing that. We're putting it with something else to sponsor, which will enhance it and help on the marketing.
Okay. Well, continuing on brands, any more that you can expand on your acquisition strategy at the moment? Obviously, we did Petra in the last couple of months. What else is on the horizon?
Well, we're always opportunistic with brands. So, you know, to call it a strategy is perhaps being a bit generous. And our core assumptions are that we have the brands that we have, and it's an increasingly impressive array, I think, and it gives us quite a lot of coverage, and we're going to grow those. To the extent that we acquire other brands, it's a bonus. It's an added extra. But over the years, they do come along. Those opportunities do come along, and our job is to make sure we have the financial firepower, so that if opportunities do come along, we're in a position to take advantage of those. But for now, I think, you know, we've still got Cleanies still at relatively early stage. We've got Petra to relaunch, and even Progress, which is we've owned for a few years now, is really beginning to find its feet, particularly in Europe.
Okay, well, just on that point of firepower, obviously interest rates continue to be low. Do you think that you are undergeared and there's an opportunity to do more with the capital, you know, cheap capital there?
Well, there's no doubt in my mind that we are, you know, below the level of gearing that we would have normally have expected. You know, and don't forget as well, what our debt is there for. It's there to fund working capital balances, which are, you know, sort of balances which turn into cash fairly quickly. So, you know, because there's debt and there's debt, isn't there? You know, our debt is not funding more speculative assets; it's funding stock and debtors which turn into cash in the not too distant future. So the fact that we are largely de-geared at this point, albeit we do expect some level of gearing to increase between now and the end of the year, with stock level increasing and also the investments in the head office, that will still only leave us at circa half a times gearing, so still pretty light. I think it does pose some interesting questions. I don't think the board is at the point of going through those. I think at the moment we're thinking, look, you know, we'll come to the end of a pandemic. There's going to be bumps in the road ahead, no doubt. We want to be financially strong coming out of it, so that we can take advantage of opportunities that we see, which may be acquisitions or maybe other things. You know, for example, like stock purchases or whatever. But yeah, I mean, I think at 1x earnings, me and Graham are pretty comfortable. At half the times earnings were very, very comfortable. So, you know, we probably are a bit undergeared is the truth.
Half the times you're wondering what else you can go and spend your money on. Good. Right. Well, you've talked there in that sort of capital markets slide about the many opportunities that have come out of COVID, you know, people liking to save their money and spending more time at home and eating and drinking more and buying your products. What about any of the shifts in the new ways of working that might prove to be a challenge going forward, both for how you operate as a business and your products?
So I don't think, I think on the demand side, we don't feel there's much to be worried about in terms of, you know, in terms of changes in consumer behavior. You know, we feel, as that slide evidences, that we're, you know, we're very much on the right side of things in terms of those developments. Operationally, I think, you know, I think we've learned an awful lot about how to work, and we do see going forward that while there will be a return to the office, we still have the majority of our staff at home for all of the week. There is going to be a return to the office, which is just as well, given the amount of money we're spending on it, and that will lead to you know, opportunities to sort of, you know, rebuild teams and enhance the workings of teams and collaboration and whatnot. But we do think that there will be an element of home working for certain tasks. We've consulted with our staff on this, and we've laid out a clear roadmap going forwards, and we've outlined, you know, how we will approach these opportunities, which will be very much case by case and task by task. You know, we feel we have a huge focus on productivity as a business. You know, that's just sort of in our DNA, and the opportunities coming out of COVID around home working are going to add to that. So we do. I mean, I can't generalize too much, because certain roles in our company will always be fully site based. You know, you can't remote work if you work in the warehouse. You know, our photography studio is in the warehouse, but then there's other roles in the business where it will be a more hybrid blend of office and home base, and we do think this will be a further kick at productivity going forward.
Okay, good, thank you. Obviously, big emphasis there at the end on your ESG initiatives. Specifically, one gentleman's asked, what is the cost of the Plant a Tree initiative?
That is commercially sensitive, because we do know our competitors are watching, but it is very cost effective, and certainly relative to the commercial opportunities that it will lead to. We're very, very excited. I mean, Simon, you've had strong feedback from retailers on this one initiative on its own, haven't you?
Yeah, they're very pleased. We're well ahead of the game, and the cost is well worth doing it.
Good. Competitors, who is your biggest, and what tactics are you using to make life difficult for them?
We see our biggest competitors as our own customers' buying office. It's quite simple. So their buying office is our competitor, and how do we go against them? We give them better products, innovation, better packaging, on-time delivery, and full service. You know, I say to my sales guys, make the buyer famous. That's our job. You know, you've got to give them products that sell at the right price, and once you do that, there's your competition gone.
Thank you, Simon. One here, do you see seasonality in your revenues?
I mean, we typically see a 55-45 split in revenue, and I think, you know, this year is looking sort of fairly typical.
Okay,
That's
thank you.
between first half and second half.
Yes, yeah.
One here from someone who doesn't know you as well. Can you provide some colour on the main license agreements, the length and the security that you have around them?
Yeah, so we have 2 license agreements for Salter, for kitchen electrical and for cookware, and we have Russell Hobbs for cookware. We don't do the electrical on Russell Hobbs, that's done by Russell Hobbs themselves. We have those both signed through to 2024. So we have 3 years. We typically would be looking to extend those once we get towards 18 months left on the licenses. We do in terms of commercial protections. You know, we obviously have decent visibility on the contracts themselves, but we've had these licenses for 10 years now, so quite long established relationships. But we try and protect our commercial position fundamentally through doing a great job. You know, these are product areas that those brands themselves are not particularly keen to do themselves. They could relicense them to other people. But the problem with relicensing them to other people is you end up with a maybe 18-month, 2-year royalty gap, because they have to build their ranges, then they have to get distribution for those ranges into stores, and realistically that's at least a couple of years before the royalties even begin to approach the levels that we're paying. And we pay 5% of revenue. So you know, with Salter, for example, we're paying the best part of £1.5 million a year in royalties there, which, you know, it would be difficult for them to replace in the short term, even with a new licensee. So it is, you know, licensing remains a risk. You know, we think it's the risk of non-renewal is low, but it remains there, which is why over recent years, you know, we've acquired Progress, and we're building that brand. You know, Petra, for example. So we always, you know, have a plan B if the worst did happen and those licenses weren't renewed.
Okay, thank you. Got a follow-up question here from the shipping costs. Obviously, they were higher than last year. To what extent would you be able to pass these cost increases on to customers if you wanted to, and what would be the lead time on that?
Well, I think
I
think on the costs, everyone's got the same costs. So it's not just us getting it; the retailer's got the same costs. And I think we managed. We had to put price increases in, but they were managed very well. We spoke to all the buyers, we spoke to everyone involved, and we put slight price increases in twice. Where other big brands were not as effective, they just sent letters to the buyers saying there's price increases of 7.5%, with no phone call, no follow-up, no explanation. So again, it's like everything is how it was dealt with, and we did get the small price increases that we needed, but we couldn't get it all. We've had to take the hit as well.
And the lead time that was able, you could turn that around pretty quickly.
Yeah, that's what we do.
Yeah, brilliant. Last one then, gentlemen. Oh, I can't hold that. Hold on, another one just come in. You all seem very relaxed and positive, which is a good sign. What keeps you up at night, and what are you most worried about and most optimistic about?
I think I'll handle the what keeps us awake at night. It feels like the last 12 months has been a bit like playing tennis against one of those machines that fires the tennis ball out. You know, you just get the ball back across the net, and then the next one comes. So I think as we return to normality, which overall is a positive development, it will bring with it challenges, because really, if you think about shipping, the reason why shipping is an issue is that it's because Western demands from China is normalizing, and there's an element of catch up even, but that's against a background of both manufacturers and shipping lines taking capacity out. So in a way, it's good. Fundamentally, it's good news. Things normalizing, but it actually leads to these sort of imbalances, and I think we're going to see as we return to normality, things happen that we don't anticipate and that we'll have to deal with and react quickly. And last week there's a national short supply of pallets, partly because of that demand and partly because timber has gone up in price by 40%. Now, 2 weeks ago, I wasn't forecasting an imbalance in pallets. That's just another unforeseen thing that's come out of the woodwork as a result of things returning to normal. So yeah, I think we're going to see more of that. And although I think about FY22, we're not going to have the headwinds, say, that we've had with, to the same extent with likes of shipping, wherever things will pass through, we'll also have other imbalances to deal with as the whole world returns to normal. I think in terms of excitement, it's got to be international. It's got to be having 500 million consumers to go after. For most of our history, we've restricted ourselves pretty much to the 70 million consumers on these islands. And I think we now feel and we now feel we know what we need to do to take our offer into Europe, and that, because that gives us growth for the foreseeable future. Off a product range that is pretty much there, give or take some tweaks. So I think that's really exciting. I don't know, Simon, if you would agree with that.
Well, I was going to start by saying, if you go back to the beginning of our strategy, the international side and the online side and the supermarket side is very exciting. But I think what's exciting me is I feel the way the customers are looking at us now over the last 3 years has completely changed. We are a serious supplier to blue chip retailers. Tesco's the biggest retailer in the country. We'll have 45 permanent ranges in there by July under one brand. I mean, that's a big saying. We've got the same going on with Argos and with Sainsbury's. And just to finish it off, probably the most exciting is the team and the talent we have in the business, because it's different to any other company that I know is relevant to us, and it is only getting stronger. So that's my most exciting. Watching all these guys developing and that are developed is going to be massive for the business. Huge.
Fantastic. I quite like there as a point to end, but I do have one more question. If the market for your goods keeps growing in Germany and the rest of Europe, do you foresee the need to have a greater local presence?
Well, we've already got a very large showroom in Cologne, and that's really handy to get to from Holland or from Poland, which is another area we've just opened. France is going to be a big focus because it's a massive market for retail products. So maybe, hopefully in the near future, we might look at a showroom in France.
Opportunity there. Lovely. Well, thank you very much for an excellent presentation and Q&A session. And we look forward to catching up with you probably 6 months' time.
Great. Thanks, Hannah.
Thank you very much.
Thanks, Hannah.
Thanks
for your time.
Bye, everybody.
Bye-bye.